I do have a question. Would you clarify which ones could be combined and which ones cannot be combined?
Sure. Yep. You can have a 401k and a cash balance or a pension plan, and you can have a SEP and a pension plan, but not a simple IRA and anything else. You could also have a pension plan and not one of these two, although typically that doesn't work as well with employees. If you have, say, a solo individual who's in their late 60s, like a doctor who's doing some consulting, doing just a cash balance can work.
We talked a little bit about really big companies like McDonald's. However, for your one-man business owner, employee, everything type person, there's a lot of versatility. And Jonathan, you mentioned that typically a cash balance or a defined benefit plan, we add that on top of like a 401k when there's employees. When it's an owner-only employee, a lot of times we can go straight, if income is consistent over the years and everything else, just to a straight cash balance defined pension plan and forego the 401k depending on their needs.
And I have a quick question.
Sure.
So with the cash balance plan, if I'm, doing a tax plan with the clients and I'm combining that with the 401k plan, so as far as the contribution for the 401k from the employer side, is that limited to the 6% as opposed to the 25% that we have here?
It is. Good question. You're getting you're advanced. So yeah. So there is what's called a combined deductible limit, which is nothing you've ever heard of unless you're a TPA or you're working on this side of the table. And basically what that means is there's a limit to the amount of compensation that the IRS will allow you to use in those calculations. So we limit the 401k profit sharing. The deferrals, that $20,500 up here or the $6,500 that's not, you can always do that no matter what in a 401k. But we limit this 25% down here to 6%, and then that allows us to give a larger amount, usually somewhere in the six figures in the cash balance. Usually we see that these only being appropriate for businesses with one individual, maybe a spouse. It can get expensive if you've got employees because everybody's got to get the same benefits. So if the owner wants to max out, they're going to end up giving a lot to their employees to do so. So the way around that is you do a 401k, and there's some different testing rules and different ways to do that. So generally with a SEP, employees become eligible in their third year of service with the employee, and there's no matching in this. So again, there's, once you're in. The nice thing about 401ks is you can include a Roth salary deferral regardless of the income limit. There is no income limit, so regardless of the income of the client, they can always do a Roth deferral, and that can be for the catch-up as well, so up to $27,000 a year in Roth contributions without having to worry about deductibility or anything fun like that. Or what most owners find more attractive is we use what's called a new comparability formula, where we skew things more towards the owners and maybe some key employees that have been responsible for a lot of the business that year, that somebody that the employer wants to make sure that they can keep around and reward. It's typically easier to do that if the owner is a little bit older than the other employees, although that doesn't always have to be the case, but we can skew those profit sharing dollars. In a 401k, you've got access to what we call a core fund menu, with institutional share classes for employees. If you've got employees in the plan, every once in a while you'll see a pooled or a trust account or brokerage used. So one thing to note too, the cash balance plan is an asset of the company. So it's if you're looking at protection from creditors, because it does not belong to an employee until they separate from service, until they either retire, they're fired, they leave the company, however. So no, this is a company account. You can set this up in a brokerage account and then manage this to grow at that 5%. It's an average, so you don't have to hit exactly 5% every year. But cash balance plans can allow for significant annual tax deductible contributions for business owners. In some cases, over $200,000 per year for an owner. In addition to what they might need to give their employees, or if you've got more than one owner, they can both do this. I know that we sent this sent an illustration out recently for a gentleman and his wife who work as consultants. They both earn about $1 million a year total, and for them, it's about $200,000 a year apiece. So, pretty nice cash flow. That's in addition to the 401k.
Now, sometimes there's competing strategies, such as, doing a minimum compensation, as minimum as possible for an owner of like an S-Corp versus fully funding retirement plans. But let's say that in this scenario, we want to, and the compensation is there for it, let's say that we want to fully fund as much as we possibly can through qualified retirement plans. Can you give us an example of maybe the 401k and the defined benefit or the cash balance and what that looks like dollar-wise?
Yeah, absolutely. Get down a little bit, so we're jumping ahead. But one thing I'll say too, a really common question that we get is, what would the owner need to make in order to maximize this? Because while we can consider up to $305,000, that's the IRS limit that we can consider. So you can make $400,000, and we can only look at the first $305,000. Not everybody is going to need to make that. I'm glad I'm not an actuary, but so I'll say that it's a fairly complicated calculation based on age, where whether or not you're an owner in the company, and a few other factors. But the owner may need to make $150,000, and they may need to make $200,000, and so there's an income that we can find for them. There's also what we call a high three rule. So we take the high three average of an individual's wages during the life of the plan. And so if you have, sometimes we'll recommend this, where you put your income up to $200,000, $250,000, whatever it takes to get that maximum calculation. Do that for 3 years, and then drop it back down, so that the cash balance, the pension plan, which is the richer side of the table, is getting those maximum contributions because you've met that high limit. So this
in a way, with proper planning and communication. So sometimes clients don't know that's an option, or they're not getting that benefit of adjusting their taxable salary every couple of years, so that they can maximize the defined benefit plan contributions, but then not overly pay in payroll taxes needlessly, simply because they're not having the communication. Meaning, the person doing the plan doesn't know that this is an option or that it's available, and they're not bringing in someone like you who can help them strategize with the cash balance plan and make sure that all the advisors are on the same page, so to speak. Knowing and understanding not only the limits, but the flexibility is critical and important. Some business owners have more consistency than others. And so it's not all about just knowing and understanding the limits. Prior to the pandemic happening, people probably thought that the world was a little bit more stable than it truly is, or than it became, right? And so a lot of people who did something that required a fixed number every single year ended up having a little bit of trouble when their revenues changed, or when local governments shut down their business or their operations because of the pandemic, or because of some other form of income interruption that happened because of the pandemic, right? And so I really like the scenario here that you've been able to paint with the flexibility of the cash balance plan, which is probably one of the more flexible plans out of all the defined benefit plans. It allows people to get in at a lower amount, a lower participation rate, meaning like just the owner rather than a ton of employees. And it does allow for some flexibility year after year after year. And that'd be an interesting conversation to also have, Jonathan. What are the common pitfalls, or what does cause a plan to fail?
So for pension plans, you're right. It's usually the most common thing is there's a business change and income, the business revenues change. I had a case a few years ago where a dentist it had a plan for a number of years, and the street out front went under construction for about 6 months. They had several setbacks, and so his continuing clients were still coming in, but that was about half of his business. About half of his business was referrals and new families moving to the area, that kind of thing. And so his business took an unexpected nosedive in revenue. dropped about 40% year over year for a couple of years, just because of when that construction was happening. And so things like that, I would say, can definitely derail a plan. Not letting us know when you've got a new owner, or we had an employer a while back decided they were going to use it like a checkbook. You can't do that. So don't allow your business owners to start taking random withdrawals. Even though it is a company asset, it is not operating capital for the company. You can't do that. That caused a long conversation with the IRS and a few $1,000s in fines, and they were happy to get that wrapped up, but not real happy about.
And John, being an owner-only plan with an S-Corp, can you tell us how the profit-sharing provision, what the max contribution could be for that 401k?
Sure. So for the S-Corp, you need some W-2 income, and the profit-sharing portion of it is 25%, up to 25% of whatever that eligible income is, so whatever that W-2 income is. Unfortunately, in an S-Corp, owner distributions don't count for that. The nice thing is, if it's an owner only, there's no need to do safe harbor, and you can set those up whenever you'd like. As the profit-sharing portion of it, you used to have to be able to do that in the plan year. You used to have the plan up and running in the calendar year. That is no longer the case. So the IRS actually did make that change as part of the Secure Act. So you can actually do a cash balance or profit sharing, or in an owner only, some situations, depending on how the business is structured, you can do those after the first of the year. So an S-Corp, you won't be able to do after the first of the year.
Essentially, the here and now, let's talk about what's happened during the pandemic with our U.S. government and the branch of the U.S. government, which is the Department of Treasury, which then also, who funds that? We have the IRS, the Internal Revenue Service, that collects taxes, right? What has happened during the pandemic? Not only have people been forced, some of them, out of their business, but the government itself had several of their employees go home. And specifically the Department of, the IRS essentially had a lot of their people working remote. But let's talk about the protocols that the IRS has. I don't know how many people here in this room, or this virtual room, so to speak, have actually been to one of the IRS headquarters in Kansas or in Ogden or wherever. But essentially, they rarely, if ever, operate by email. In fact, their virtual means of transferring data and information is incredibly limited for security purposes, because we're discussing some of the most sensitive financial data for a United States citizen or anybody that pays taxes here. Your socials, your birth dates, any number of other data that could be used for fraudulent purposes. And so their means of securing it is somewhat antiquated and almost prehistoric. Literally, they receive data from clients when requested, either by mail or by fax. Now, if they are working remote and working from home, how are they going to receive a fax in the office? And how are they going to receive the mail that comes in? To date, this is something that a lot of people don't know, because almost everybody in the world has returned to some degree of normalcy after the pandemic. But to date, over 50% of the IRS agents are still working from home. Now, they might be able to do some phone calls, right? But if they've requested information and they're only going into the office one day every 2 weeks, one day every month, how much progress is actually happening? How much is actually getting done? My viewpoint on the hiring and the surge of new employees, one is, this is a solution politically to our growing national debt. It's an effort towards that, but how likely is that going to happen in the short run? It's very unlikely that with the lack of efficiency currently there, that things will happen immediately. However, I believe that you'll probably see some people who just never do go back to working in the office. And they eventually might be replaced by a lot of these younger, more tech savvy, and there might be new protocols put in place to actually run more efficiently as a government in collecting taxes. And roughly around the next 2 to 3 years, you will see a degree of efficiency hit our internal revenue service that has never existed before. Largely due to this surge in hiring and possible, and there's no publications about this, by the way, no publications about a possible replacement of current personnel. But if you were an employer and you had a pandemic and you gave people an understandable period of time to return to work and they never did, I mean, what eventually has to happen, right? And so what a lot of people are concerned and afraid of is the here and the now, like today, like 2021 taxes. You know, we've got some deadlines coming up, 2022 taxes. Or maybe they're amending the last 3 years' taxes, which, by the way, you have to mail those in. And the fact that they might not even be looked at for 9 months, right? So I think maybe a little bit more on a one-on-one conversation, we can talk about the impact of what that looks like, and maybe whether or not, you know, your level of interest in making some very favorable changes, and how aggressive you feel that they might be reviewed or looked into, etc., so that you can properly plan for everything that you're doing right now and going forward in the future. Again, thank you everybody here on the panel for your questions. Thank you for all the messages that have been trickling in. Some of those we've left until afterwards to answer more directly. Look forward to seeing you all next Tuesday. We have another guest speaker. Look for those announcements on LinkedIn, and we will see you next time.